Have you ever noticed how two people can start in exactly the same place, make completely different financial decisions, and spend the next 20 years convinced they're the smart one? It's one of the most fascinating things about money. Give two people the same income, the same savings account, the same opportunities, and somehow they'll still end up arguing about the right way to build wealth. One person swears by real estate. The other believes the stock market is unbeatable. And both of them usually have enough success to feel justified. But here's the problem. Most people compare these investments using incomplete math. They focus on the exciting numbers. They talk about appreciation, they talk about cash flow, they talk about market returns. But they rarely talk about time, stress, risk, concentration, leverage, or the hidden costs that quietly eat away at returns year after year. So today, let's do something different. Let's follow two ordinary people over 20 years and see what actually happens when real life enters the equation. Meet Jake and Marcus. They're remarkably similar. Both have managed to save $50,000. Both earn around $55,000 a year. Both are disciplined enough to think about their financial future instead of spending every dollar they earn. They're the same age, they live in the same city, they're starting from virtually the same financial position. But one decision sends them down completely different paths. Jake looks at his $50,000 and sees opportunity in real estate. Marcus looks at the same amount and sees opportunity in the stock market. Both believe they're making the smarter choice, and both are about to learn that building wealth is far more complicated than most people realize. Jake uses his savings as a 20% down payment on a $250,000 rental property. It's not a mansion, it's not some glamorous beachfront investment. It's simply a modest 3-bedroom home in a decent neighborhood where families want to live. The numbers look attractive. With a mortgage at 7% over 30 years, his monthly payment comes out to roughly $1,330. After some searching, he finds a tenant willing to pay $1,800 a month. That means approximately $470 a month left over, at least on paper. The moment Jake sees those numbers, he feels like he's cracked the code. Every month, someone else is paying his mortgage. Every month, someone else is helping him build equity. He imagines future appreciation, future rent increases, future wealth. And honestly, it's hard not to get excited. Meanwhile, Marcus takes the same $50,000 and places it into a total stock market index fund. No rental agreements, no property inspections, no mortgages, no leverage, no tenants, nothing flashy. He simply invests the money and sets up an automatic contribution of $300 every month. Then he moves on with his life. When coworkers ask what he's investing in, he gives a simple answer: index funds. The conversation usually ends there. Nobody leans forward with excitement. Nobody asks follow-up questions. Nobody is impressed. And that's exactly what makes investing in index funds so difficult psychologically. The strategy works precisely because it's boring. On day one, Jake has something tangible. He can drive past his property. He can take pictures of it. He can show friends. He can proudly say, "I own that." Marcus has an account statement and an email confirmation, not exactly dinner party material. And that's where many people make their first mistake. They confuse excitement with effectiveness. The investments that feel the most impressive aren't always the investments that create the most wealth. For the first few years, Jake genuinely feels like he's winning. Rent arrives every month, the property seems stable, home values in the neighborhood slowly rise. His tax situation improves because of deductions like mortgage interest and depreciation. Everywhere he looks, there appears to be evidence that he made the right decision. The investment feels alive, it feels productive, it feels real. Marcus, on the other hand, experiences almost none of those emotions. He occasionally checks his account. One quarter it's up, another quarter it's down. Then it's up again. Nothing dramatic, Nothing exciting. No tenants call. No one congratulates him. No one asks for advice. His portfolio quietly grows while attracting almost no attention. And that is exactly why so many people underestimate the power of compounding. The early years are incredibly underwhelming. That's the secret nobody talks about. Compounding is almost invisible at first. The first few years don't feel life-changing. The first few years don't generate exciting stories. The first few years test your patience. By year 3, Jake has collected nearly $65,000 in rent. That sounds fantastic. His mortgage payments total almost $48,000. On the surface, it looks like he's generated close to $17,000 in profit. Many real estate discussions stop right there, but real life doesn't. Because properties don't operate on spreadsheets. They operate in the real world. Property taxes arrive every year. Insurance premiums increase. Water heaters fail. Roofs leak. Tenants move out. Repairs happen at inconvenient times. Suddenly, that beautiful profit number starts shrinking. A leaking roof costs thousands. A water heater replacement costs more. Vacancies create lost income. Cleaning expenses appear. Advertising costs show up. Small repairs become constant. One unexpected expense follows another. By the time Jake subtracts everything, his actual profit looks dramatically different from the number he originally calculated. And perhaps the biggest expense isn't even listed anywhere: his time. The late-night phone calls, the repair coordination, the tenant screening, the property visits, the paperwork, the stress. All of those things have value. Yet most investors never assign a dollar amount to them. Marcus has a completely different experience. His contributions continue automatically. His portfolio continues growing. He spends almost no time managing it. No emergencies, no unexpected maintenance, no frantic weekend repairs. His investment asks almost nothing from him. And that freedom matters more than many people realize. Still, real estate has one powerful advantage: leverage. This is where things become interesting. Jake controlled a $250,000 asset with only $50,000 of his own money. That magnifies gains when property values rise. After several years of appreciation, the home may be worth significantly more than what he paid. His equity grows through both appreciation and mortgage paydown. This is real wealth creation. And it's one reason real estate remains so attractive. The bank helped finance the majority of the asset. That's difficult to replicate with traditional stock investing. But leverage is a double-edged sword. When things go well, it accelerates wealth. When things go poorly, it accelerates pain. And that's a distinction many investors forget until they're forced to learn it firsthand. One of the biggest myths in real estate is that rent equals profit. Nothing could be further from the truth. Rent is revenue. Profit is what remains after everything else is paid. And that difference is enormous. Properties require constant maintenance, even when nothing appears broken. Roofs age, HVAC systems wear out, plumbing deteriorates, appliances eventually fail. These aren't surprises, they're guarantees. The only surprise is when the bill arrives. A furnace replacement might cost thousands. A roof replacement could cost even more. And unlike stock market fluctuations, these expenses don't wait for convenient timing. They show up when they show up. That's why successful real estate investors think like business owners, because that's exactly what they are. They're not simply collecting rent, they're operating a business with customers, expenses, liabilities, and risks. By year 5, Jake understands this better than ever. The excitement hasn't disappeared, but reality has replaced fantasy. He's dealt with tenant turnover. He's faced repair bills. He's handled unexpected costs. He's experienced the frustrating reality that every landlord eventually encounters. The investment still works, but it's far less effortless than it appeared at the beginning. Meanwhile, Marcus continues doing something that sounds absurdly simple: nothing. He keeps investing. He keeps waiting. He keeps allowing time to work on his behalf, and something fascinating begins happening. The growth starts accelerating, not because he suddenly contributes more money, not because he discovers a secret strategy, not because he becomes smarter, but because compound growth reaches a point where gains begin generating their own gains. The snowball starts rolling faster. At first, Marcus was building wealth primarily through contributions. Now his investments are beginning to contribute alongside him. And that's when compounding transforms from a concept into something tangible. Around the 10-year mark, the comparison becomes genuinely interesting. Jake's property has appreciated substantially. His mortgage balance has fallen. His equity position looks impressive. Years of ownership have created meaningful wealth. There's no denying that. But getting there required effort, real effort, hundreds of hours, countless decisions, ongoing responsibility. Marcus arrives at a surprisingly similar destination. His portfolio has grown dramatically. His contributions continue, his returns compound, and his wealth begins approaching levels that once seemed impossible. What's remarkable is how different the journey felt. Jake actively managed wealth creation. Marcus passively allowed wealth creation. Both strategies worked, but they demanded completely different lifestyles. This is where personal preference becomes just as important as financial return. Because money isn't the only thing you're investing. You're also investing your energy, your attention, your freedom, your peace of mind. And those things matter. A lot. Now let's fast forward 20 years. This is where long-term investing reveals its true power. Jake owns a property that has appreciated significantly. His mortgage is nearly gone or completely gone. The asset produces income. His equity position is substantial. He's built real wealth. The kind of wealth many people dream about. The kind of wealth that creates options. The kind of wealth that can change a family's future. But it came with responsibility every step of the way. Marcus has experienced something equally remarkable. His portfolio has transformed into a powerful wealth-building machine. Decades of compounding have done their work. Years of discipline have produced extraordinary results. And much of that growth came from simply staying invested, not predicting, not timing, not reacting, just staying the course. When the final numbers are compared, something surprising happens. They're often much closer than people expect. The gap isn't nearly as dramatic as the internet likes to suggest. The real difference isn't always the money, it's the path. One investor accepted leverage, concentration, and active management. The other accepted volatility, patience, and passive investing. Neither path was perfect. Neither path was effortless. Neither path guaranteed success. But both created wealth. And that's the lesson most people miss. The debate between real estate and stocks often becomes emotional. People defend whichever strategy they chose. They want validation. They want proof they were right. But wealth building isn't a religion. It isn't a sports team. It isn't about proving someone else wrong. It's about choosing a strategy you can consistently stick with for decades, because consistency beats brilliance far more often than most people realize. The biggest risk isn't choosing real estate. The biggest risk isn't choosing index funds. The biggest risk is choosing something you don't fully understand. Or worse, choosing something because an influencer, podcast host, or social media post convinced you it was the only path to success. Real wealth isn't built through headlines. It's built through discipline. It's built through patience. It's built through understanding the trade-offs. Every investment has strengths. Every investment has weaknesses. Every investment requires sacrifice. The people who succeed aren't the ones who find a perfect strategy. They're the ones who stay committed long enough to let a good strategy work. And perhaps that's the most important lesson Jake and Marcus teach us. The question isn't whether real estate wins. The question isn't whether stocks win. The real question is whether your investment strategy aligns with the life you actually want to live. Because if a strategy makes money but destroys your peace of mind, is it really a victory? And if a strategy gives you freedom but keeps you awake during every market downturn, is that truly success? The best investment isn't necessarily the one with the highest return. The best investment is the one you can confidently stick with through good times, bad times, bull markets, recessions, repairs, vacancies, crashes, and recoveries. That's what creates wealth, Not excitement, not predictions, not shortcuts. Consistency, time, and the willingness to keep going when the results aren't immediately visible. Because in the end, wealth doesn't usually come from making one brilliant decision. It comes from making a good decision and giving it enough time to work its magic.